So we want to make sense of like which segment to go in, because once we get this right, we then able to maximize the real gain. And right now we want to go into the next, understanding the outlay to your returns. So for the points, you would have probably pay around 458,000 as a down payment given the 1.63 million buy price. Okay. And for the Trevor, you would have probably down pay about 441 inclusive of stamp duty as well. So how hard your money is working for you? Effectively, the Trevor is the one because of the price gap as well. So the next segment we want to go into is new homes against sub-sale. So how does that look like? So this is based on a development that are within the same district, not too far off, called the Trevor, against the points, which is a sub-sale. And this was done in fourth quarter 2018 to third quarter 2022, over a 16 quarters period, which is another 4 years. So what we're trying to illustrate here is about 4 years window. If you buy within which segment, how much, which segment actually gives you the best return. Okay. So Trevor, it's launched in 2018. So this is a brand new TOP in 2022, 729 units development. The points launched in 2015 and also TOP in 2019. And the number of units here is 731. Okay. So that's it. If you were to buy different entry point here, okay, for Trevor as a brand new, entry price was 1,576 per square foot. And when it comes to the exit, it's about 1,829. And for points, we are using the entry of 1,634 because the lower chart here shows mainly a new sale. That means there were still remaining units unsold by the developer. So we can't use that. We've got to use the sub-sale. And in this instance, it's 1,634 PSF. Okay. And when they exit about 1,823. So noting that the entry price of these two development, where new homes is 1,576 and sub-sale is 1,634, which is a lot more expensive. Okay. Right now, which project will you buy? Will you buy Trevor, which is T, or will you buy points, which is P? Okay. And this is very important because you need to know which is undervalued right now. So play a game with me. Type in your answer inside the chat so I know whether you know which particular segment is right now undervalued. Okay. So most of you are saying T. Okay. Right. Awesome. So you guys are getting the segment right already. Okay. Yes, points is actually a mixed residential. Rather, you also, it is an integrated as well, because the fact that it is linked to the I wouldn't say directly linked, it's just covered walkway to the Potong Pasir train station as well. All right. Okay. So most of you are getting it right now. So when it comes to assuming it's 1,000 square foot, you would have bought in Trevor at 1.576 million and exited at 1.82 million, making around a profit of 253,000 with 16% capital gain with a 4% annualized gain over a 4-year window. Okay. And for the points, you would have entered around 1.634 million as a sub-sale and then sell it eventually at 1.823 million, making 189,000 with 12% capital appreciation over a period of 4 years, and that would be 2.9% annualized gain per annum. Okay. So considering that sub-sale has rental income yet again, and the rental market rate was about, going up to 192,000, which is about 4,000 per month over 4 years. Okay, minus off your brokerage fee, bank interest, rental, repairs, property tax, and non-owner occupied rates, and also maintenance fee as well. And of course, your agent commissions over here, your stamp duties, your legal fees when you sell and you buy. Your net margin works out to be about 84K. Okay, and when you buy the Trevor, you do not have the other fees that the sub-sale has to pay, but of course you still have to pay the same thing, which is agent fees, stamp duties, and legal fees, and this will give you a net margin of 116K. Okay, so even though Points Residences was basically is right now on top of the MRT and Trevor is far from the MRT, guess what? Because of the segmentation of the price disparity or the price gap, right now the real gain for Trevor is actually making more than the points, right? So we want to make sense of like which segment to go in, because once we get this right, we then able to maximize the real gain. Okay, and right now we want to go into the next understanding the outlay to your returns. So for the points, you would have probably pay around 458,000 as a down payment given the 1.63 million buy price. Okay, and For the Triver, you would have probably down pay about 441, inclusive of stamp duty as well. So how hard your money is working for you, effectively, the Triver is the one because of the price gap as well. And the last segment we want to show is resale against subsale. Okay, so these two developments are very familiar for you guys because you would have heard it that I'm also one of the ex-owner of Coco Palms, right? Okay, so this is actually located at Pasir Ris. These are side by side. Okay, so that's it. Looking at Dines is a product that is launched back in 2013 and TOP in 2017, a 912 units development, comparing to Coco Palm that it's launched in 2014 and TOP in 2019. Okay, and the timestamp we are using is 2018 to 2022, again 4 years of investment horizon. So that's it. If you are entering at Dines, you would have entered at 1,089 PSF and exit at 1,143. And for Coco Palm, you would have buy higher at 1,182 PSF and then sell it off at 1,282 PSF. And the PSF comparison here is 8.5%. So you've been learning just now, the gap this year between resale and subsale is almost 24%, just comparing based on the first based on this year TOP developments, right? And this is 8.5%. So right now, which market is actually undervalued here? It's subsale or is it resale? Okay, if you're getting right, just type in your answer. So if you think that it is Dines, is like Dines, which is a resale. If you think that, you know, subsale is undervalued, which is Coco Palm, just type, you know, C inside the chat. So I know that whether you think Dines is undervalued or Coco Palm, which is C. Okay, right. Okay, we can see that there are more C here. Okay, I'm very happy because you guys are getting it. Okay, and this is very high level, I know. But if I don't give you the real nuggets, then of course, how are you going to make the real gains, right? Okay, so how many of you felt that this exercise that we're doing here is actually very, very, I would say, makes your mind think a lot, okay? Very analytical for you. You need to do some form of critical thinking, right? Okay, if that's you, just like me inside the chat so that I know that right now you feel this is, you know, really useful. You're able to see things yourself without getting people to really need to advise you and things like that. Okay, because we're all using numbers here. Investments are about numbers. And if you hate numbers, then unfortunately, this is a huge component of provision you're missing out when it comes to investment. Okay, right, awesome. So that's it. We are looking at total quantum here, assuming that you will enter at about 1,000 square footage as well for Dines. You have paid about 1,089,000. And it comes to exiting, you will probably exit about 1.143 million. Okay. And for Coco Palm, you would have entered about 1.182 million and exit at about 1.282. So understanding this, the total gain for Dines is about 54,000, which is 5% cap gain, and per annum is only 1.2%. Okay, for Coco Palm, it's 8.5% over the 4 years window with 2.1% annualized gain. And when it comes to the rental over time, we are using all the same rental because they are side by side. So we're not going to change the rental income that is coming in from both, which also means that their property tax would also be the same. And also the maintenance, we also try to put it the same, so it's all else equal here. All right. So that's it. The real gain is about 70K for Coco Palms. And when it comes to Dines, okay, given it has rental income as well, right now the real gain is only at 30K, okay, which is about 2.8% over a period of 4 years and is 0.7% annualized gain. So given these numbers here, right now you can see that Coco Palm actually does better in terms of real gains comparing to Dines. And using the outlay computation again, 327,000 for Coco Palms, paying a bit more. And against Dines, that your down payment is slightly lesser at 300,000. Basically, Coco Palms investors or landlord has his money working harder for him, getting double the returns of what he's getting if he were to buy in Dines, right? How many of you felt that this is really, really something you never thought of before? Okay, so I just want to know, because the thing about price gap, many people just think about, okay, this is, you know, the price gap between this and that, so these are undervalued. But if you look at 3 different segments, right now it's very confusing, right? But only if you get it right now you can really see things for it is and which segment is actually undervalued. Okay, so with this, some of you must be thinking, which should you be concentrating on? This is what is your focal point here.